You want to take a wild guess at how many retail stores have closed down just this year in 2024? Go ahead, put your guess down in the comments. Almost 6,200, guys, 6,189 store closures so far this year. Last year, the total for the whole year was 5,553. So we've already far surpassed the 2023 numbers of store closures throughout the country, and we still have a couple months left to go, which means this is going to be far worse than last year. So people want to look at the headline numbers and say that the economy is good, but when you look at these sort of numbers, just a simple thing, how many stores are closing, it is actually going up substantially. And let me tell you something, this is kind of common sense that everybody should know, and I can't believe I have to say this, but stores don't close during good economies, okay? Stores open. People are opening businesses, starting businesses, not closing them down. What this trend tells us with all of these stores closing is that consumers have reached their breaking point. People are no longer spending money on things that are unessential because they can't afford it and because they no longer need it. People also bought a lot of stuff during the pandemic when everybody did get that boost of income and had extra money to spend and didn't have to pay their bills for a while. Sales for a lot of these stores were pulled forward 5-10 years of sales into the future. A lot of that demand has already been satisfied. People don't need to buy a new computer or a new phone right now or other things that last a while. Then of course there's also the competition. You know, you have Amazon, Walmart, Costco. Those are like the biggest retailers in the entire country that sell pretty much everything and compete on price for just about everything, making it hard for other retailers to stay in business. You know, it's funny because a lot of people say they don't want to live in a world where Amazon and Walmart are the only retailers and that's the only way you can buy something. But I disagree because most people vote with their wallet. And every time you buy something from one of these big retailers versus a smaller retailer, you're telling them we want to do business with you versus somebody else. And who can blame them? You know, everybody wants the convenience of having something shipped to your house the same day or the next day, or getting the absolute lowest price on something. You know, that means something to the customer, but it's also going to come with a sacrifice in that there's going to be less buying options in the future. And as these conglomerates grow and get bigger, there won't be as much competition, which also means there's not going to be as much of a reason to give you a better deal anymore. So just think about that. I'm not telling you to buy everything from all the small mom and pop retail stores around you, but realize once they've all been wiped out and they're all gone, what incentive does Walmart or Amazon or Costco have to offer you the lowest price anymore? They really don't, because now they're only competing with each other. Who knows, maybe they'll even become Walmazon at some point. But this trend of retail stores closing can be traced all the way back to 2017 or so, because just in 2017 and 2018, there was more than 13,000 retail stores closed across the country. In 2019, actually the year before the pandemic, there was a record 9,800 retail stores closed. So this problem has actually been brewing under the surface for quite some time. And then once the pandemic actually happened and people had a bunch of extra spending power, it was able to buoy up a lot of these companies and allow them to artificially stay in business for that extra 4 years or so that they normally wouldn't have been able to. But because of all the extra money that was injected into the economy, they were able to grab a chunk of that. But now that all that spending and all that extra money has dried up and has already been spent, these companies that should have went out of business essentially 4 years ago and should have closed their doors are only starting to do it now. This also proves that all the money that was injected into the economy during the pandemic was a giant mistake, guys, because all it did was delay the inevitable. And what I mean is just look at all of these businesses that are closing their doors right now that would have closed their doors 4 years ago if there was no pandemic. And they're only just now closing the stores now because the spending has dried up. So it really only temporarily made things better for everybody. We just kicked the can down the road, but the big problem is now we have a whole lot more national debt than we did before the pandemic that is probably never going to get paid off, which makes every American poorer by nature. According to this report, more than 80 companies that sell discretionary goods have filed for bankruptcy through September of this year, which is up 27% from just 1 year ago. Some of those companies are places like Tupperware, Big Lots, Joann Fabric. Those have been some of the largest bankruptcies we've seen so far this year. I've already gone over with you guys several times all of the restaurant bankruptcies that have been happening over this year, literally at all-time highs. You can go back to the year 2000 and you won't see as many restaurant bankruptcies as we're seeing right now, guys. But don't worry, things are great. That's what we're being told. And one of the biggest warning signs that our economy is starting to falter is places like Family Dollar. You know, they're struggling big time because most of their customers are low income and they've had to scale back a lot of their spending. And so now you're seeing a place that traditionally caters to people that don't make a lot of money, they're losing sales now. Same thing's happening with Rite Aid and CVS and Walgreens. All the drugstores are starting to go out of business and close their doors. But of course, it's not all doom and gloom. There are stores that are opening as well. It's not like it's just like stores are closing. We've had 5,300 stores announced that they were going to be open this year. That's still less than 6,200 as far as I can count. And speaking of bankruptcy, Bed Bath & Beyond was one of those stores that recently went completely bankrupt and they lost all their locations, guys. So Overstock took over. They bought Bed Bath & Beyond for $21.5 million and turned it into a fully online retailer last year. So the name of the company used to be Overstock.com. Is called Beyond Inc. And they just said that they're going to be laying off 8,000 of their workers, which is 20% of its workforce, just by the end of the year. So if you're somebody that works for Beyond Inc., you could now be on the chopping block and be losing your job very soon. They say that by cutting this many jobs, it will allow the company to save approximately $20 million a year, guys. So like I said before, companies don't care about you. They're not here to make sure that you do well. They're just there to protect their bottom line and make sure their shareholders do well. And I'm sure this announcement is going to make the share price of Beyond Inc. go up. This is what shareholders like to see. Layoffs are good for business. In fact, even the chief production officer was laid off from Beyond Inc. as well. She was the first one to go, essentially. And she's just going to be the first of many. So pretty much anybody's on the table for losing a job at Beyond Inc. right now. So yeah, all this stuff must just be signs that things are going amazing. And it's easy for people to get that impression, especially when they look at the stock market, because the stock market is still sitting at all-time highs, has not really seen any major corrections, just some small ones here and there throughout the year, but nothing like what we saw in 2022. You also have gold right now sitting at a record high. But the problem is, it's not very typical for the stock market to be sitting at an all-time high as well as gold sitting at an all-time high. So essentially, one of them is going to have to be wrong. Which one do you think it is? Because here's the thing. Now that gold is sitting at an all-new record high, this is a big warning sign to all investors, including people that invest into the stock market. They know that this is an unusual thing to see happen at a time when stock prices are at all-time highs. And the reason why that gold is at an all-time high is because people who purchase gold have zero faith in the fact that the Fed has tamed inflation or maybe will ever be able to tame inflation ever again. I think it's possible for them to do it, but the problem is they're not willing to do what it takes. If the Fed was truly concerned with taming inflation, interest rates would be north of 10% right now and make borrowing for everything so prohibitively expensive, maybe even higher than that. Look, they had to go to 18% back in the late 70s in order to get inflation under control. It could take something that drastic again to really get inflation down to where it needs to go, guys. But the thing is, they don't want deflation. Deflation is the worst nightmare of the Fed and our government because that means they can't print any more money. You know, so the show is over. But gold being at all-time highs right now, what this says to an investor or the stock market is that we are either going to have a recession or inflation will be sticky or both. I think it's probably going to be both until the recession creates some deflation. You know, if the recession gets bad enough, then we are going to see prices on things continue to fall as the demand also falls with the recession. Because if people lose enough jobs and there's not enough money to go around, people aren't going to be buying things as much anymore. And here's the thing. Recessions and inflations are bad for stocks. Also, stagflation is bad for stocks. So gold is basically pricing in a high probability that one of these scenarios, if not all three, are going to take place. And I would tell anybody who's nervous about the price of stocks right now to buy gold or silver instead, guys. Like, I'm not a financial advisor. I'm not somebody who's going to tell you how to run your entire financial life, but that's what I personally am doing, and I can sleep good at night knowing that my money is in a safe asset that is not going to be deflated away and isn't going to go down 50% overnight because of an investor panic. Okay, so that's why I like those assets. But it's not for everybody. But here's the reason why gold is likely going to be right and the stock market is going to be wrong. You have central banks around the world buying up gold. China bought a bunch of gold, Russia bought a bunch of gold, India bought a bunch of gold. And funny enough, these are all the BRICS countries. These are all the countries that are stacking up and starting to gang up against the United States in hopes that they can ditch the dollar in the near future. Another reason to be bullish on gold is because central banks are cutting interest rates. In Europe and as well as UK and Canada, they've already slashed interest rates substantially. We've already done a 50 basis point rate cut here in the US. And that could lead to higher inflation, which is already starting to happen here. These other countries already have higher inflation than we do. So people that are smart realize that, hey, if I buy gold or if I buy silver, I may be able to get ahead of this thing and not have to worry about losing my entire wealth to inflation. Now, of course, the stock market benefits too from inflation. That's why it is as high as it is right now, is because of all the inflation. You can look at how much that things have gone up since pre-pandemic until now, and that'll give you a pretty good idea of how much inflation we've really had in the economy. And here's the thing, guys, if the Fed doesn't engineer this fabled soft landing that they've been shooting for, which seems like it's not going to happen, it's already not happening right now, if you ask me, this is going to push gold prices even higher, because investors are going to completely lose faith in the Fed's ability to have any sort of control over this economy. I mean, the bond market is already screaming that right now. They're already saying that the Fed has lost control because the Fed lowered interest rates, but the price on treasuries has gone up ever since then because they don't believe that the Fed has things under control. And it's because they don't. I don't know if you guys could hear that, but it was very beautiful, the piano. Somebody up there in that house is playing piano, and one of these days, whenever I slow down from making all these YouTube videos, I'm gonna learn how to play the piano. I've always wanted to learn how to play, so that'll be fun. Here's something else we can look at that probably proves that gold is going to be on the right side of this economic crash and not the stock market. And that is that Goldman Sachs, they just predicted that the stock market is likely going to see a lost decade. So a lost decade is a time frame when there's essentially no gains. I'm not saying there's going to be a major crash, there could be, but it also means even if there is no major crash, then you're not going to be really making any significant returns in the stock market either. So according to Goldman Sachs' most recent report, they said that the S&P 500 will return just 3% a year for the next decade and only 1% after adjusting for inflation, which is kind of hilarious too, because that's assuming that inflation is actually only 2%. So if inflation remains high like it is right now, the core inflation numbers are still well over 3, closer to 4, then you'll actually be negative if you own stocks during this lost decade. You will actually come out with less money than you had in the beginning, even though the nominal value was higher. But they're saying this is likely going to be the worst stretch of the stock market since the Great Depression, because going back the previous decade, stocks returned around 11% on an annualized basis. So the stock market has been a fabulous investment for most people for the past 50, 60, 70 years. But the reason that Goldman Sachs says this is going to happen is because of the massive concentration in the Magnificent Seven stocks. The Magnificent Seven are the big stocks that have the highest valuations in the world, like Amazon and Apple and Alphabet that owns Google. And Goldman Sachs says it's extremely difficult for any firm to maintain high levels of sales growth and profit margins over a sustained period of time. And so that same issue is going to plague a highly concentrated index, which is the S&P 500. So most likely what we are seeing is that all of these companies that continue to see their valuations go up are seeing this demand for their services and their valuations pulled forward 5 or 10 years due to the pandemic. If it wasn't for that, we wouldn't have seen this massive soar in stock prices or home prices or anything else. And another thing you can do, guys, if you have some extra savings and you have some extra money laying around and you don't want to just buy gold and silver, even though I think it's smart to be doing that right now, you also want to have some cash on the side. And I mentioned the other day, high yield savings accounts have been seeing a reduction in rates, even though interest rates on everything else are going up, which is completely unfair. But I did find a story that highlights some banks that are still paying 5% or higher for a high yield savings account. And I'm even going to check these out for myself, because I think all the ones I have now are paying less than 5% at this point, or very close to 5%. So here's some of the banks that still have good returns on high yield savings. And one of them is called Pi Bank, P-I-B-A-N-K. They're supposedly the highest right now out of everybody with 5.5% APY. You also have New Tech Bank at 5.25% APY. And those are really the only ones that are still over 5%. All the other ones that used to be like Ally, BMO, Discover, Popular Bank, they're all paying less than 5% now. And I know it's kind of a hassle to open up new bank accounts and make transfers all the time, but hey, it only takes like, half an hour of your time to do something like that to make a little bit of extra money. But right now, I'm just sitting here idly watching to see what move the government or the Fed is going to make next to try and save this whole economy, guys, because I feel like they're pretty much out of options. Most people think they're going to go back to QE and start printing money again, which is a very strong possibility that they do. But just remember, all that's going to do is cause even more inflation and cause the price of everything to continue to rise, which is even more of a reason why you want to have gold and silver or be stacking away cash right now, because you're going to need it in the future. So if you enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.